What's better, to own 100% of a grape or to own 10% of a truck filled with watermelons? Culture and revenue are correlated. So if you want to build $1 billion business, you're going to need people. Don't hire for the job you have open today, or the talent you need today in a job. Hire for the company you're going to be in 5 years.
Welcome to the Startup Huddle. I'm your host, Jozef Maruscak, and I'm excited to introduce you to the current and upcoming leaders of the startup tech world. We'll discuss digital products and key takeaways for life and professional growth. So grab a coffee and let's huddle up. Hey everyone, today we are here with Adam Coffey, who is a very, very experienced businessman, has several exits under his belt. He's also a veteran, a writer, wrote 3 best-selling books, currently a coach. So there's going to be quite a lot to discuss today. Thanks very much for coming, Adam.
Oh, thank you for having me. Very good to be here. Hello to all your listeners out there.
Perfect. So before we start, we're going to be today talking mostly and focusing mostly on scaling tech companies, exiting tech companies. And then if we have time, we'll also touch upon the private equity play and how does it all fit together. But before we start, Adam, could you tell us a little bit more about your background, because it's fascinating by itself?
Sure, happy to. So, I tell people there's kind of our lives are a collection of experiences. If I think about my experiences that lead me here today, you mentioned veteran in the Army. Military taught me something about discipline, teamwork, and leadership as a young man. So I think it's important, if we're entrepreneurs, if we're business people, that we are highly disciplined and focused on our goals and objectives. And I credit the military with teaching me something about that early. Engineering background, I'm a pilot. Engineers, taught me how to be an anal retentive strategic planner. So never get up in the morning without a plan. And if we're building a business, we need to have that roadmap, already thought out, ahead of time. Being a pilot, pilots don't take off unless they know where they're going. They know where their destination is. And I think a lot of times for entrepreneurs, we don't set an interim destination. We're not building to a certain size and then looking for our first exit. We're just building. We don't really know when we've succeeded or when we've achieved our goals and objectives because we haven't laid out the destination. And so I think being a pilot taught me that. I spent 10 years working at GE in the Jack Welch era. GE was the number one company in the world at that time, largest company in the world. Tech really hadn't taken over yet. Jack was the world's most admired CEO, and it was GE, the world's largest company, that was growing so fast. It was doubling in size every 3 years, and that informed my thinking that a 30% plus compound annual growth rate is what we really should be targeting, in business when we're building a business. Every business I've run subsequent to that, I've been able to achieve the same thing I had to achieve at GE, which is a 30%, kind of growth rate. And so GE taught me how to run a company. I then spent 21 years building 3 different companies for 9 different private equity sponsors. I bought 58 companies, buy and build guy, buy a bunch of companies, put them together, build a big empire. And I have $2.5 billion in exits under my belt as a CEO. And I got bored. After 21 years of being a CEO, doing it for institutional shareholders, I got bored. I had written a book, at that time, 1 book, not 3. And I was teaching at a university, teaching the next generation of business leaders in an executive MBA program how to beat the odds, how to be successful. And that really resonated with me. So I did a career pivot. I had been making a ton of money as a CEO, but I wasn't really having fun anymore. It was kind of boring, and then at the same time, it's like I love teaching. So I flipped my world around, and I now spend my days working with private equity firms, helping them determine what investments to make. I work with founders who are scaling or doing mergers and acquisitions, and eventually they will be selling to private equity. And then I'm still teaching. So I just put out a 3rd book a couple months ago. And I teach seminars to a global audience, and I've been having a lot of fun continuing to help entrepreneurs be successful. And that's really been my goal is, I've been wildly successful. It's time to help give back. It's time to help the next generation of people excel as an entrepreneur. So that's kind of the background in the life.
That's a fascinating background for sure, and also maybe even a better mission now that you switched from being the operator to actually now teaching and spreading the knowledge. So great there. Let's start with the scaling of the businesses. So most of our listeners are going to be founders, I think, at the beginning of their journey, sometimes early stage, and then maybe to like Series A, and some investors as well. So how would you compartmentalize the different stages of the company? In the startup world, we tend to talk about companies, at seed stage, pre-seed stage, seed stage, then through Series A to C, D, etc. Do you have any other system there, or how do you think about scaling the companies as in terms of the categories?
Yeah. So I'm going to roll back to just before that. We're going to get into that. But let's just say your listener is out there and has not yet decided what they're going to start or what they're going to build. How do it's a big old world out there. How do I decide where I want to play, in that world? And so when I'm coaching entrepreneurs, or people who don't yet have an empire, they're just starting out, I kind of use this framework. And I start with needs versus wants. Well, let's start with invest in what you know. You can be successful in any kind of business or industry on the planet. You don't have to start the newest tech craze or create the latest app that billions of people around the globe are going to use. And if you look at the empires that I've built, billion-dollar businesses that do things that aren't very sexy, commercial laundry, HVAC, and the first was a medical repair company. And if you looked at all the companies that I ran, they had some common DNA: guys, trucks, broken stuff. Not to sound sexist, ladies, but guys, trucks, broken stuff, guys, trucks, building things. That's kind of my wheelhouse, right? And so start with invest in what you know. Invest in, and so I usually would work with entrepreneurs and I tell them, look, on one column of a piece of paper, write down your skills, just generic skills. Hey, I'm very analytical. I'm very good at spreadsheets, planning. I'm good at strategy, or I'm good at inspiring. I suck at strategy. I don't know. I can't do spreadsheets. It's like, what are you good at? And then where are your passions? And what kind of industries would benefit from your skills and your passions? Because if we can find something to build that we're passionate about, and it plays to our strengths, higher probability of success. So I start there. Next up, I go to needs versus wants. So if I think about a business, is it fulfilling a basic need or is it a want? And so let me give you an example, a needs versus wants. If I'm sitting here in my home office and it starts raining and the water's falling on my head, I need my roof fixed. And that's a need. I drive a big monster truck and, it's got 700 horsepower and it pops wheelies. And it's like, that's my Armageddon, zombie apocalypse escape vehicle. And, if I got a truck, I want to pimp it out. I want to add accessories to it, but that's a want. My wife, we're going out to a concert on Friday night. I want a new outfit, and so we have needs in life and we have wants. Why does this matter? Because far too many entrepreneurs who are starting something are not focused on needs, they're focused on wants. And our economy moves in cycles. And businesses that are focused on wants in a down economy get hammered because the consumer or the company, if it's a want, not a need, I can turn off my spending. My spending is discretionary. And if I suffer from a bad economy, I can dial back that spend, but I can't eliminate the spend on a need. So I tell entrepreneurs starting out, focus on needs, not wants. And what I'm trying to do is I'm trying to insulate your chances of failure and focus you and have a higher probability of success. So here's some statistics for the USA. There are 34 million small businesses in the United States, and the US government defines that as 500 employees or less. So it could be a pretty big company and still be called small company here in the US. Only 7% of those ever get to $1 million in revenue. and only 4% of the 7% ever get to $10 million in revenue. And only 40% of these small businesses are profitable. They make up 99.9% of all companies in the US, and they employ half the country's workforce. And so, it's like, why is it so hard to be successful? It's because people didn't invest in what they knew. They didn't focus on needs versus wants. Now, the next layer of that, if I've got a need, I want recurrent revenue versus non-recurrent or project-based revenue. So, I mentioned roofing as an example, and, hey, by the way, I can make money in any of these industries, but I want you to be successful. So in order for you to be successful, I want to limit where you're investing and where you're playing as an entrepreneur to try to focus you and have a higher probability of success. And so needs versus wants, recurrent revenue versus project. So if I acquire a customer, which is the hardest thing for most businesses to do, if I'm a project-based business, so let's say I build things, I'm putting roofs on houses.
Yeah. I can maybe just jump in there because, for example, my business and Sudolabs is a project-based business, and we've been thinking for quite some time how to find a recurrent revenue. Because, as you say, we built tech for startups and now tech for larger enterprises and AI transformation for larger enterprises. But what normally happens is that it takes a lot of effort to acquire that customer, and then the customer simply leaves. And of course, when the customer is successful, they might come back to you and invest more money in their tech. But it's mostly a project-based business, as you said.
Yeah, and the hardest thing for us to do is get the customer. So once we get the customer, if we can get a regular revenue stream. So a great example here in the United States, of a company that has kind of recurrent revenue. Let's talk about pest control. So I live in Texas. There's giant bugs out there that you could put a saddle on and ride them around. They're big. And so everybody has a pest control contract. So we sign a contract, and then as a consumer, we forget about it. And every month that company is charging my credit card, and they only come out once a quarter to spray my property, for insects and what have you. And so it's a very efficient machine. I acquire a customer, I have their credit card, I'm charging them every month, I'm coming once a quarter, and nothing, I've been living in this house for 3 years, and for 3 years I've been paying these pest control companies. I don't think about it, and they just keep coming and they keep hitting my credit card. It's like, we want to create some type of recurrent revenue stream. And so you mentioned being project-based. So I was project-based in the last empire that I built. And so sometimes what we can do is, if we have a project-based business, is find ways to make strategic pivots so that we're also trying to create recurrent revenue streams within our project-based business. And we may never get to where it's 90%, call it recurrent, but if we can go from 90% project to 40% recurrent, 60% project, it's all about what can we do to try to generate recurrent revenue, so that once we've captured that customer, we have found other things that we can sell them, or other things that we can do to build a relationship with their money, and keep that business and that relationship growing. And so that was the second piece. The third thing then I look for is, before we scale, we have to get our business working correct, small. And this is where a lot of entrepreneurs make a mistake. A lot of entrepreneurs say, hey, Adam, I'll figure it out. As I get bigger, I'll figure out how to be profitable. And I tell people that's the wrong answer. We want to learn how to be profitable small. And so my focus as an entrepreneur would then be, I'm investing in what I know, needs versus wants, trying for a recurrent revenue component. But then I apply this thing I call the 30-20-10 rule. And, if a private equity firm, the largest PE firm on the planet, hires me to look at an investment for them, I use this same rule. I look at the 30-20-10 rule. So the 30-20-10 rule essentially is this. I want to look at taking a business and breaking it down to its lowest level component. The unit level economics is what I call it. So I talked about pest control, so let's use that, or an HVAC company or a roofing company. And it's a guy in a truck. How much revenue can I generate? What is the cost of the person, the vehicle and the operating expenses? And for revenue, to service the revenue I've got, doesn't matter whether I'm a project-based business, I'm a product business, a service business, whatever revenue I've got to service that revenue in order to earn it. and I need to have at least a 30% gross profit minimum. I'd like higher, but 30 is the minimum. That's the 30 in the 30-20-10 rule. The 20 is SG&A. So SG&A, sales, general administration, that's my back office. I want to keep my back office costs at less than 20%, because non-negotiable in the 30-20-10 rule is I need to generate at least 10% of net profit, after all of these other expenses. If I do not generate a 10%, net profit at the bottom, don't scale. Work on the unit level economics, perfect the business small, because if it's not working small as I'm scaling it, my problems just get larger. So all my focus should really be in the early days, putting together a model, putting together something that's focused on needs, not wants, recurrent revenue, and then if I can generate and pass the 30-20-10 rule, now I'm ready to scale. I'm ready to grow, and I'll grow profitably. And success is already a foregone conclusion. So I think too many businesses, especially startups that are doing traditional VC funding, are just thinking, I just got to get to this series, to that series, and I don't need to make any money, and I can worry about making money later. And I tell you, if you want to be successful, you want to build a $1 billion business, if you can make it work small, guaranteed it'll work large. It'll get better as it gets larger. But these are my thoughts, heading in to a business. We should not be starting something hoping I can just get to the next round of funding. Let's start something that's profitable from day one, that I can put some focus on, get the unit level economics dialed in. It's passing the 30-20-10 rule. Now I'm all about scaling revenue. I can put away the formula on how to build a successful business and focus all my attentions on scaling it. So if that makes sense, that's how I attack this.
That makes sense a lot. However, like as we see, especially for tech companies, like they're mostly, and traditional VC route is to mostly focus on the growth and just try to essentially grow many times, no matter the costs. How would you tackle this?
Right.
Yeah.
So VC investors, if you look at the average VC fund prospectus, they don't do any better than the stock market. There's a whole lot of failures out there. So I'm not teaching you how to be one of the millions that are out there failing. I'm trying to teach you how to be one of the ones that are successful. And so if you're building a tech company or a software company, I still have, what's my unit level economics? It was, I've got software development costs, yes, and I'm going to have program losses, but at some level, I have to be able to model out, profitability with the lowest amount of customers, lowest amount of users. And I have to be focused on profitability. And too many people, especially in tech, are not focused on building a great product, that's profitable. They're just focused on getting from one round to the next. And but at the end of the day, when I look at VC fund prospectuses, generally they suck. They do worse than the stock market. VC investing is not a place for the common person who doesn't have sophistication as an investor. That is a great asset class when I'm looking for the diversification and I want exposure to potentially hit home runs. But, again, so, not to be critical of what you just said, but I just want to say that we don't want to be the average. We want to be the exceptional. And if we're going to be the exceptional, we're going to figure it out early, how to revenue. And so tech is different, especially software. But the principles are not different. I'm going to have a licensing cost and I'm going to need a volume to cover, call it my SG&A. So although I've got development costs, which are capital expenditures, I can still be planning for what's the cost, that I'm going to sell the license, the monthly license for, the user fee. What are my SG&A expenses? What's my customer acquisition expense? I can still think about it in terms of when I'm operationalizing this idea, what is the formula that's going to take me to success? And by the way, the better I can demonstrate that to investors, the easier that funding becomes.
Yeah, for sure. And this is exactly what I wanted to point out, that especially in the past year or year and a half, it seems to be when you actually, the biggest chance you're going to get the funding is to show some revenue, ideally profitability, even in the beginning, although, you're in the let's say MVP stage, if you can show some revenue and show some profitability, that's going to be a home run for you in terms of the investments. And now, right now, even at later stages, we see all those companies dying because they will never be profitable, and it's almost impossible for them with incredibly high valuations, right?
But yet those entrepreneurs sometimes think that that's success. Success was, I had an idea, I got people to invest in it, and they didn't make any money. What we're doing is we're wasting time. And time is the one thing that rich people cannot buy. And so I would tell you, we want to be really efficient with time. And it's not just about getting my mediocre idea from one stage of funding to another. It's if I can't hit a home run here, I want to bail on this thing quickly because I'm wasting time. So time is a critical element here. And you've heard it, I'm sure. The adage is fail fast, fail often. But don't waste time.
That makes a whole lot of sense. So now we went through all the steps, how to think about the business before you start, and how to figure out.
Can I just make one more comment to your listeners out there? A lot of times we overthink our entrepreneurial journey up front. We think we have to do something new. We have to create, the next TikTok, or the next platform that's going to make me billions. It's like, can we just focus on getting $1 million in revenue and being profitable and generating profit? It's like, don't overthink things. If you look at some of the world's most successful investors, take guys like a Warren Buffett as an example. It's like there are just millions and millions and millions of companies that aren't very sexy that are already out there doing things. And people have built billion-dollar businesses in these industries. So it doesn't have to be sexy. Sometimes just reinventing, or the better, taking something that's old and not sexy, like laundry or HVAC or plumbing, or roofing or flooring, and just doing it well, doing something that everybody needs and doing it well. And it's not very sexy, but at the end of the day, we can make a lot of money and we can scale these companies. So don't always think that don't always overthink and think that your idea has to be. I get that all the time. Adam, my idea plus your wallet equals success. And I tell people, if you think of me as a wallet, you don't understand my value, because my value's up here. I can get capital anywhere.
And he also touched upon in the very first stage, try to build something with the skills that you have. Try to focus on the industry where you can use your skills plus the passion. How much the passion is important, do you think? Because we see many early stage entrepreneurs that are just trying to find the market opportunity. They do those basic exercises on how to, exactly identify the growing market. Then, some differentiating point, etc. How much the passion is important in the early stages?
When entrepreneurs think in that fashion, which is just what's my angle to make a buck, when they don't have passion, they also don't find success. Think about the world's wealthiest people. Think about people like Jeff Bezos or Elon Musk. Pick Sir Richard Branson. I mean, think about just people in life who've been successful beyond, their wildest expectations. And I think universally you'll find that they have passion. They have passion for what they're doing. Success, or failure is not an option. When you can find passion for what you do, you can't wait to get up in the morning and dig in. Then the potential for success is just exponentially higher. So I would tell you, if you don't have passion in life, now people have asked me, so I built $1 billion laundry company. Adam, how the hell can you be passionate about laundry? Well, I'm not. I'll give you that. That company fulfilled a service that nobody on the planet likes. I don't care where you live. Everybody has to do laundry and nobody likes to do laundry. There's nobody out there that gets up and says, yay, it's laundry day. And so but it's a need. Everyone has to do it. And so I wasn't passionate about laundry. I was passionate about people. I was passionate about building a successful empire, taking care of my employees and, giving back and all the things that I could do with success in that industry. So my passion was the business and the people. And so I would say, if you don't have passion, your business will reflect your lack of passion. and that will translate to a lack of drive. So recalibrate.
So it doesn't necessarily have to be passion in the particular industry or in the particular type of business, but you need to be somehow motivated to run the business and grow the business, right? And so passion might be find somewhere else than in the particular industry or type of business. For example, you might just pretty much like to be entrepreneur and you like to grow companies. This is enough, but you need to have that drive there.
Yes, it have to. Some people stumble into success, but they're the exception, not the rule. People who are passionate, who work hard, people who focus kind of on this framework that we've been laying out here today. If you can couple all of this together, then your chances and probability of being successful are much, much higher. Something else I'll tell you, I know we're focused a lot on creation. I'll tell you that sometimes for an entrepreneur who's just starting out, rather than starting from scratch, sometimes it's better to go out and buy a small company and start with a base. So if I think about, just this, like some of these companies that we've been talking about, I could start something from scratch, or I could go buy a small company that's currently run by somebody. Maybe they've been in business for 10 years, 20 years already. It's a proven track record. They've got customers, they've got revenue. I can look at their financials. I can apply the 30-20-10 rule, and so I think about more from venture capital to what's called the buyout, or the buyout type of fund activity, which is where, maybe it's a search fund. I'm an entrepreneur. I want to be an entrepreneur, but instead of trying to find the next best thing, let's just go buy something that someone else has already been successful with and see if I can't apply a new energy to it to find a way to bend the growth curve and take it somewhere where that entrepreneur could not. And right now in the world, as what we call baby boomers are retiring, so people born after the end of World War II, up until about 1964, there's the world's largest wealth transfer taking place right now as all of these people get to retirement age. They're selling their businesses. Can I find a lifestyle business that meets needs versus wants, that somebody else worked for 20, 30 years? They weren't trying to set the world on fire with it. They were just trying to earn a living. But I can look at the model. I can see that the basic math works. And so for me, it's take something that's already in existence and works, and how can I now take it to a new level using, call it my modern thinking, my framework for methodology for building a business. And now I can focus on M&A and scaling, and I'm starting from a base of success. And capital, I think most entrepreneurs think the hardest thing in the world to find is capital. And I'll tell you that if that's the way you think, you need to recalibrate, because the world is filled with money. And so how you treat money when you need money is the magic at getting people to yes. If the prevailing interest rate is 10 or 12, then, or it's 8%, give someone 10. If it's 10, give them 12, give them 15, give them 10% of the profit on what you're building, give them the warrants or some stock, in the adventure. If you treat money well, money will take a chance on you and you'll have a higher probability of finding success. There literally are trillions of dollars in capital out looking for projects to fund right now. So money isn't the issue. Money's the commodity, that we need to go get. How we treat the money when we don't have a track record, right now, if I want money, I call any number of people and I'm going to get money because I have a track record. I have a history, of building very successful companies. When you don't, you have to be generous to money. And a lot of times entrepreneurs get overprotective. I got the greatest idea in the world, and I'm only going to give you this little minuscule piece of it. Hey, if it's your first time out of the gate and you don't got any money and they do, give them a good chunk of it. Let them be successful and get a great return, because for you, what's important is getting out of the gate, finding the capital you need to be successful. So don't be stingy, be generous. Be generous as an entrepreneur and founder with a great idea, and you'll find it easier to raise capital.
But I completely agree with this. And many times, people get stuck with their ideas for years and years. And at the end of the day, there's nothing out of it because they didn't have capital or proper means to even try that idea properly. So I also
can I tell you something else too? Yeah, just percent of ownership. People get hung up on, I need to have control, or I need to own 100% of this. And so I want to give away little chunks. It's like, what's better, to own 100% of a grape or to own 10% of a truck filled with watermelons, and it's, I think about the world's wealthiest man, and this changes based on stock market values, but not too long ago, it was Jeff Bezos. So Jeff Bezos only owns 10.9% of Amazon. Well, if the world's richest man can get there by only owning 10.9% of his company, which means that 89.1% is owned by somebody else or whatever, 89.1, it's like, can we not just get over ourselves and recognize that when we truly partner with people, getting to a good outcome, it doesn't matter what the percent is that we own. What matters is that we get our ideas to fruition, they get funded, and we find the success.
Exactly. And ideally, we shouldn't slice the non-existent cake, right? I mean,
Exactly.
Yeah. So so we now know how to start the idea. What about the scaling? How would you say we should approach the scaling?
So this is why I think that understanding your unit level economics is so critical, because what I want to do is I want to build 2 formulas. Actually, I'm going to build 4 formulas. When I'm starting to revenue a business, I'm going to build a formula to get to the first million, a formula to get to the first 10 million. Why those 2 levels? Because only 7% of entrepreneurs who start a business get to the first million. And only 4% of the 7% get to 10 million. But once I get to 10 million, the scaling part becomes much easier. And so I build an economic formula for revenue, and I build one for capital expenditure. And so we talked about, like landscape maintenance, or we talk about pest control, or, just an unsexy business that everybody around the world understands. I got guys in trucks out doing stuff. How much revenue can one truck? My unit level economics in a service business, generally it's one truck, one crew. I'm project-based business. I got one truck, one crew. How much revenue can they produce? What are the unit level economics? Okay, so based on that, how many trucks do I need on the road to get to 1 million, to get to 10 million? And then what are going to be the direct expenses? What's going to be the gross profit for one truck, that gets me to 1 million? How many trucks, to 10 million? And so I want to build an economic formula that goes all the way down to the customer level. How many customers do I need to find every week, every month, in order to make this level of revenue happen? And so I get very, I'm not, you talk about left brain, right brain kind of thinking. It's like, I'm an engineer by background. I want to build a formula. I want to build a formula for success. And so, because once I have the formula, then it's down to tactical execution. I know I'm going to need 7 crews to get to 1 million. I'm going to need 52 crews to get to 10 million. I'm going to have to buy, 7 trucks, 52 trucks. It's like I can build that plan for both revenue and capital expenditure, and how many customers do I need? And then for me, it's about execution. And I want to get out of the gates, get to that first million, be one of only 7% of companies here in this country that get to 1 million. Recognize 93% of entrepreneurs that start something never get to $1 million of revenue. So let's just get that hurdle behind us. And I find that this framework we laid out really helps me do that. And then go to the 10 million mark. And so how much capital am I going to need to get there? How much revenue am I going to need? And then once I get to that point, boy, I'm successful. I've beat the odds. And so, I wrote a book. My last book was #1 bestseller, is Empire Builder. It came out a couple months ago. And I walk you through going from 0, to 1 million, 1 million to 10 million, 10 million to 100 million. And what you'll find is that once you've got it dialed in and working small, scaling becomes infinitely easier than building the original business. And there's different behaviors that we have to go through as entrepreneurs at these different levels, different activities. And so going 0 to 1 million, ain't no retentive control freak. I got to control every aspect of the business to make sure it's being replicated properly according to my formula. And then going from 1 million to 10 million, now is my first kind of little ramp up. And I'm like, okay, I'm perfecting the model that got me to 1 million, and I'm getting to 10 million. And once I get there, now I'm ready to stop thinking about unit level economics, and I'm ready to start thinking about how can I grow faster Do I, my addressable market, if I'm a service business, do I have a big enough area to generate enough customers, or do I need to go to an adjacent market, that's, around, and I need to open up my second branch office, my third branch office. I talk about planning the exit in mind. For me, in the service industry world, which is what I usually do as service companies, because they're really CapEx efficient. And when I do all these models and formulas I'm talking about, you'll find that a $10 million service business throws off more than $1.5 million in free cash flow. And I only need $1.2 million in capital to buy everything I need to build that $10 million business. But I start thinking about the exits, from the beginning. I'm building to $4 million in EBITDA. And if I do, a service business is going to sell for about 8 times here in the US. And so I'm planning for a $32 million exit. Or I'm going to go to 10 million in EBITDA. And so to get to, call it, let's say the 4 million in EBITDA, if I've got a 15% EBITDA business, or a 25%, I can calculate what the revenue is, that I'm going to have to get to in order to hit that 4 million in earnings. I can sell it for 8 times or 32 million. Or I'm going to 10 million of EBITDA, at which point I'm going to try to sell it for anywhere from, I'll call it 12 times, and so I'm looking at $120 million exit, and so I'm planning to be, to getting to my exits, because I want asset diversification. I want to monetize the asset. I want to put a bunch of money in the bank. I want to become Jeff Bezos, become a minority investor now with private equity or somebody backing me. I'm going to use their checkbook, and I'm going to keep on scaling, but now I'm going to accelerate the pace of growth. Mergers and acquisitions become a potential. They become attractive. And so I have a framework that I lay out in my last book to just really guide, because at each stage, in a company's existence, you're talking about early stages and A and B and all this stuff. It's like, all that's happening really low. What about the rest of it? That's, the road to $1 billion, and so there are these distinct behaviors and tools that we as entrepreneurs need to be able to deploy. And I see a lot of entrepreneurs who do find success, by the way. These are the rare people who find success. There's 2 things I want to mention. One is there is an inadvertent, I'll call it, arrogance of success. Once we start to find success, we convince ourselves we're God's gift to the world and we don't need any help. And we're the smartest person in any room, doesn't matter what room. And so we stop learning. And generally we find a ceiling somewhere around $30 million in revenue where we've got no more bandwidth. We've suffered from the arrogance of success, and now all of a sudden we're stuck. We can't get any higher. And I talk about entrepreneurs, having a second gear where you needed to be anal retentive, strategic planner and control freak to find the initial success. But now that we're scaling, you need to find and learn, how to reach this different entrepreneurial gear, which is I want to articulate the vision. I want to, be the aspiration of the business, but I want to hire good people, empower good people, and get out of their way. And I become the conductor of an orchestra rather than the first chair player of every section of the orchestra. And if I can learn how to make that shift, then 30 million to 100 million happens rapidly, and 100 million to $1 billion becomes possible. And so I've got to be a control freak to get out of the gates. When I find initial success, don't let it go to your head. Recognize you constantly need to surround yourself with talent and with good people who can challenge you and help you think new and think differently. You got to keep growing. And then if I can find that second gear, I'm going to shoot from 30 to 100 million rapidly. And now I'm really going someplace special.
That's definitely helpful. I think that, as you said, you start with being the operator. Your hands are involved essentially in every aspect of the business, and then the larger the company becomes, the more you need to let go, right? And yes, ideally to keep growing in order for the business to be successful, because it will never be scalable if you keep be involved and micromanage everything that is involved there. This is, I think, very related to exits. How and generally speaking, it is often said that any business should be almost independent from you as the original founder in order for you to be able to sell it. Now, you also mention, large amounts of revenue and how the businesses should grow, what to do in order for them to scale. Tell us a little bit more about exits, because you've written the whole book about this. So what a good business needs to have in order for the business to be sellable, and how to prepare for it.
Well, the first thing as an entrepreneur out there, don't think about exits as being a one and done event. Don't think about, I've built a company, now I'm going to exit, and I want to exit fully, and I need to then go off and do something new. I like to think of exits as the first stop on the wealth creation highway, rather than the last stop of my entrepreneurial journey. Because if I give you a wheelbarrow full of cash and buy your company, first thing you have to do is figure out, what am I going to do next? And because I've got a non-compete, I'm not going to go back and do the same thing. I got to now do something new. And while I might know a little bit more about success, finding that second successful exit, could be more difficult. So I tell people, look, you just spent your life, you spent some period of your life getting passionate and building this thing that's successful. Why walk away? Why not keep on going? Become a rollover investor. So instead of cashing out 100% of our chips, I think about cashing out about 70% of our chips, getting asset diversification, but now staying as a minority investor with private equity or someone now using their checkbook. And with an unlimited checkbook, I can now accelerate the pace of growth in a business I'm already very familiar with, and I can go for another exit. And so, my record personally is selling the same company 5 times in a 13-year, 4-month time period. So if I roll over 30% and I get a 4x multiple of invested capital on the next bite, that 30 cents becomes $1.20, which means my second bite of the apple is actually bigger than the first, which generated the dollar that I rolled 30% forward with. And so, the second bite's bigger than the first bite, the third bite's bigger than the second, fourth bigger than the third, so on and so forth. And so I want many bites of an apple. Now that I've got my company humming and it's working and it's successful, I want to keep growing it using other people's monies. I don't want to leave. But if I did, then, as you said, I have to have a leadership team in place who is the face of that business, who can perpetuate that business, so that when I sneak out the back door, and I'm going to set it up this way, I'd say, look, I'm just a chairman of the board now. I'm not active day to day. Jozef's the day-to-day guy, and that's the magic behind the business. And then the entrepreneur, the money comes in and says, okay, we're going to back Jozef, Adam, you can sneak out the back door, right? So it's like, it's okay, you go. So I have to make sure that I've got a strategy in place, that it's not about your exit. Think of it in terms of, it's about their exit, and it's the next owner's exit after that. We need a 10-year roadmap. So if someone's going to buy us, and something that we all do, we try to sell hockey stick projections. This is what the company was doing, but magically when you buy it, give me a wheelbarrow full of gold, it'll grow like it's never grown before. I tell entrepreneurs, rather than try to sell a dream, sell the bending of the growth curve. Get on that trajectory so that I can forward project what is actual rather than a potential or hypothetical. Don't talk to me about what you think your business will do when I magically give you a bunch of money. Show me what your business is doing today, because that's the trend line that I want to see. So we have to have a story. That story has to be supported by numbers. I have to have a leadership team that allows for the business to perpetuate itself, even if if I'm absent. Because here's a scary statistic for you. 73% of entrepreneurs who sell to private equity don't survive the first 5 years, with private equity. So they just gave me a wheelbarrow full of gold. I'm feeling good. I've got the accidental arrogance of success. I'm a rich person now. I've got a wheelbarrow full of gold, and I check out. I decide I don't want to work hard anymore. And my new partner, who just gave me all this money, they want me and expect me to work harder than I've ever worked before because they gave me a bunch of money. They now got to get their return. And to get their return, we got to keep growing at 30+% a year forever. And if we do that, our company will double in size in 2.8 years, triple in size in 4.2 years, and quadruple in size in just over 5 years, which is the normal PE hold period. And if I can get on that kind of a growth trajectory, I'm guaranteed 4x, 5x multiple of invested capital, every time I exit the business, a second time, a third time, a fourth time. You got to show them the roadmap. You got to show them how that's going to happen, because not only do they have to buy it, they have to get their return, but then they have to sell it to someone else who sees the ability to continue so that they can get their return. We have to really have a 10-year horizon, 10-year story as a leader. And then I'll tell you too, when it comes to, so I got to have a team. I got to have, what I'll call sophisticated processes and procedures. And I have to, have the growth story that's backed up by my numbers, not just my Kool-Aid hockey stick projections for the future. It's so I'm thinking that, that these are important. These are the most important things. But then I'll even go a step further and I'll say, should I hire a banker or not? A lot of entrepreneurs get hung up on, geez, I'm going to pay a 2%, fee, a 3% fee to a banker. But, the PE never sells a company without hiring a banker. That should tell us something, right? So the world's most sophisticated sellers hire bankers when they sell. I need to create a competitive tension. I need someone who's got an understanding of market dynamics and who's buying today in an industry. And it may include intelligence that you just can't even think of or dream of. Hey, I know that this firm has been runner-up on the last 3 tech companies that look like yours, and they've put a lot of money and work in. They came up empty-handed. They're going to dig in like you would never believe because they got to win the next one. Or here's a fund that just started. It was 3 years ago, and they haven't made an investment yet. Their LPs are starting to get nervous. And so, cost be damned, they're going to buy the next company that's in their wheelhouse, and they're going to stretch for it. It's like I need someone to represent me in the marketplace that understands those kind of competitive dynamics that are at play in order to maximize the potential. Because today, I'm a seller. Tomorrow, I'm going to become a rollover investor and a partner to my buyer. But today, I'm a seller. And so I want to maximize the potential of the business. I want to pick the right partner to be with for the next 4 or 5 years. And then I'm going to worry about my return when I get to the other side of the fence and I put, my 70 cents on a dollar in the bank. So a lot of different intricacies and dynamics, but we the more we look like a private equity backed portfolio company before we sell, the better the outcome. PE is looking for the risk. They hire a guy like me to look at your company and say, where are the risks? Where am I going to get hurt? Because I'm money. I'm not the expert in running these businesses. Adam, you are. So help me figure out where the risks are, because once I identify the risks, I discount what I'm going to pay. And so when I work with PE, I help them find risk. When I work with entrepreneurs, I help them eliminate risk, and I help them look more like a PE portfolio company so that when they don't find risk, they pay up, and they pay more for the asset. So many nuances on exiting. But I think my number one lesson for entrepreneurs is don't think you have to be done at an exit. And I would say oftentimes you're leaving too much money on the table. Those second bites, third bites are very lucrative and attractive. And just ask Jeff Bezos.
That's kind of an unconventional look at it. So great to learn that also from me as well. I also thought about the exit as like a one-off thing where I will just start something new. But as you said, it doesn't make much sense, especially if you get such an amazing amount of money into your business and you know how to drive the business and how to handle the business. And it works. It works
the odds, right? You've become successful. Why leave? That's the wrong time to leave. You just got the home run. Let's keep riding that gravy train, filled with cash.
Yeah, makes complete sense. So maybe we can on a closing note now, just in all those years that you've been running businesses and selling businesses and advising businesses, what are maybe the top advice, something that the key learnings that you could tell to young entrepreneurs now?
We've covered a number of them today. I like my basic tenets: invest in what you know, focus on needs, not wants. So I'm stacking the deck in my favor. Some of the things we didn't touch on, though, I'll say culture and revenue are correlated. So if you want to build $1 billion business, you're going to need people, and if you want to attract people, especially in today's world, think about how hard it is just to get people to work, in today's world. It's like, but if you're going to build $1 billion empire, you're going to need people. You better treat people well, and you better focus on building a strong culture, because if you can build a strong culture, then human capital, you become a magnet that attracts human capital, that retains human capital. You'll be able to get the employees that you need to build the empire. So I think culture is very important to our businesses. We need to focus on taking care of people in order to find and have enough people to build the empire. So that's one. I think another potential focus is make your journey not about you, but about the collective. You'll find your success. Every great idea doesn't have to be your idea. It's like, I find I'm not the smartest guy in a room. I don't need to be. I hire for talent. Another little tip I'll give you is that when I'm growing and scaling a business, the company's going to be growing so fast, 30+% a year, that it's going to grow by a magnitude of 4 times in 5 years. Don't hire for the job you have open today, or the talent you need today in a job. Hire for the company you're going to be in 5 years, because as you're growing, if you're hiring for today's need, you may wind up outgrowing the talent that you bring in, and you're putting yourself in a position where you have to constantly be turning over talent. So I like to hire more talented people potentially than I need in an organization. People who know what bigger looks like, and they can still roll up their shirt sleeves and reach down and help me grow and aspire to be something bigger and more special. So, and then we have to also let our people share in the wealth creation and the value creation that we are undertaking. And so I always am seeking alignment with employees. And so creating incentive pools where employees become owners in the business, and get a chance to get a taste of that exit. And I've created a lot of millionaires in my career. And I think that's probably the funnest, activity for me, is the day a company sells, is to walk around my headquarters and see a bunch of people hitting enter on their keyboard, looking at their bank account balance, waiting for the wire to hit. And then when it hits, and they're, it's like, I'm a millionaire for the first time. And so I my last count, I'm somewhere around like 80 millionaires that I've created in my career, people that I've worked with, and so I love sharing the wealth by creating incentive pools that get pushed pretty far down into an organization. I find that if I take less than potentially I'm entitled to, and I share a little bit more with the people around me, they tend to work harder, and they work harder for our collective success. And so take care of people is another big aspect of this, but make sure that they participate in that value creation. They'll work harder, and I think those would be a few.
Thank you very much, Adam. I think this is definitely going to be useful for the listeners. It was a very nice chat. I think that we could be talking for 2 or 3 more hours. There's a lot of knowledge you can share. So I just advise the listeners to maybe buy your books or look at other podcasts, other stuff that you have done. And thanks again. Pleasure, Adam.
Thank you for having me, and good luck to all your listeners. Be a doer, not a dreamer. Get off your backsides, make it happen. Don't just dream about doing it. Get out there and do it. Thanks, everybody.
And that's it for today's episode of the Startup Huddle. Thank you very much for listening, and make sure to catch all episodes on thestartuphuddle.com and follow me on LinkedIn and Twitter for more insights and updates on the world of startups. Thanks again for tuning in.